The topics that we're going to hear are nominal income targeting versus inflation targeting in advanced and emerging economies, growth, natural rates and policies from Guy, and rebalancing monetary and fiscal policies then from Peter, in that order. And I'm so delighted to see reverse alphabetical order. Usually it's with us at the end, as it is in the next session. But here's Peter Abelson at the end. But Peter was respondent to a late scratching, as am I, for participation in this session. What we've agreed to do by a rather strong and prolonged social choice process between the participants was 20 minutes each to talk, but after the 20 minutes, 5 minutes of questions for the specific speaker on specific issues attached to the speaker's presentation, and then that would leave us 15 minutes at the end for them to attack each other or members of the audience to talk about overall themes that emerge from the discussions in this session. So we'll move in the order indicated, that Warwick will talk first, and then Guy, and then Peter. And Peter wrote his paper with, don't touch, with a guy called Tim Dalton. So we should have Bond music from Audio Visual Effects at the time that Peter takes the platform. I'll introduce each of the speakers as they come up to speak. Start with Warwick, and then I'll introduce each speaker just before they step up to speak. Warwick's got what's called a Vice-Chancellor's Chair in Public Policy at ANU and is Director of the Centre for Applied Macro Analysis in the Crawford School of Public Policy. He's very well known, of course, for his global economic modelling, the McKibben-Sachs model and other things, and contributions to modelling monetary policy, his presence on the Reserve Bank Board and his many publications. So we're delighted to start off with a presentation, please. Thanks, Warwick.
Great, thanks very much, Glenn, and thank you to the organisers for inviting me to present today. This topic is on nominal income targeting for advanced and emerging economies, and it's a joint paper which is not yet complete. Unfortunately, the empirical work is yet to be completed, but it's with a PhD student who's from the Central Bank of Liberia, Augustus Panton. I want to stress a few key points because in case you either A, leave the room, or B, fall asleep, you'll know what the conclusion is very quickly. And that is that people seem to think that we know what the optimal monetary framework is and what the optimal fiscal framework is, but in fact it's an empirical question. What determines the best way to run monetary and fiscal policy depends on the characteristics of your economy and the nature and severity and persistence of domestic and foreign shocks. So there's no preordained reason why the inflation targeting would necessarily be the best framework. And in fact, there is the theoretical evidence, which is very widespread and has been 50 years in the writing, plus the empirical evidence, suggests that there isn't an actual dominant framework. So it comes down to what do you think are the key issues you face as a country and what sort of shocks, what's the structure of your economy. We know what regimes are really bad, so fixed exchange rates in most cases or a fixed money rule, but there is a fine line between how you choose amongst the ones that are good. And really, if you're thinking about where we are today, the world is highly uncertain. And given this, it's really important that the system you set up has a balance between clarity of the regime so that the markets know how you will respond, so people can understand the framework in which you're operating, and also transparent flexibility, which means that if something comes along and you hadn't anticipated it, it's very clear why you're doing what you're doing, and it's not trying to get some economic benefit by undermining people's expectations. One of the key issues that worries me and many other people is that there's an enormous amount of leverage by households and governments all around the world, and that's because we're in an environment of very low interest rates and very low inflation. But this means an incredible amount of vulnerability. If interest rates start to rise, we're going to see some very interesting adjustments. And in the bottom line is, if you look at where we think the shocks are going to come from, in fact, the theoretical result that nominal income targeting is better than inflation targeting in most countries is actually, in my view, the way that we should move forward. So I'm making the argument that inflation targeting regime work well when you were disinflating. It doesn't work so well given the state of the world that we're looking at going forward. So what I'll do in this presentation then is just get the global context where I think the world is, talk about very briefly the monetary policy regimes, and it will be a choice between nominal income targeting versus inflation targeting, and then draw a conclusion. So what we're seeing at the moment, and most countries are facing the same set of global issues, and that's the transformation of the world economy as the very large emerging countries become part of the global system. So we have billions of workers and firms, changing relative prices, impacting on countries around the world. And at the same time as these big external pressures are impacting individual countries, there's a lot of countries, particularly in the advanced economies, that are actually going through very serious structural adjustment problems, coming from excessive debt, leverage, demographic change, low productivity. So there are country-specific issues and there are global issues. And the big problem you see is that for many years these long-term issues or long-term shocks have been in the system, but policymakers have not actually responded to the structural requirements, but they've instead these have pushed up against the rigidities, and policymakers have focused on short-term cyclical policy as a way to deal with increasing unemployment dislocation. So if you look forward, what do we expect to see? Well, in the medium term, there's a global demographic adjustment, which is both big and asymmetric across countries. There is evidence of a global productivity slowdown. There's a big issue with fiscal sustainability. There is a series of policies which will be implemented differentially across countries. We'll deal with climate change, whether you believe it or not. There will be policies in place. There's always a risk of pandemics. In the shorter term, we have to deal with President Trump's monetary and fiscal mix, which is, if it ever gets through Congress, is potentially a big shift in global macroeconomic settings. We are going through a period of weak global investment, contradictions in Europe, structural adjustment in China, Japanese policy experiments, and I could keep going and going and going. There's a lot of stuff out there in the world which would be impinging on a country like Australia. Oh, and geopolitics, you always can never ignore geopolitics. So just to give you an idea very quickly, this is the population growth rates by region across 4 different time periods. The first bar in each block is recent history, and then the next 5-year steps. You can see that in all countries in the world, population growth rates are falling, and in some countries they're shrinking. Secondly, if you look at productivity, I've already mentioned this is just labour productivity. You can see that in all countries in the world, productivity since the Great Recession has been falling, although it's higher in some parts of the world than in other parts of the world. The trend is down, but there is still quite a bit of asymmetry. And again, this final chart is just to make the case that there's a lot of government debt in the system. Don't want to spend too much time on this, but this chart shows you for each country in the OECD what the total amount of debt is the total of the bar, and the colours represent different time periods. So the blue bar is how much debt there was at the beginning of the financial crisis. The red bar is the debt accumulated during the financial crisis, and the green bar is the debt accumulated since then. You add the 3 together and you are where we are now. If you look across these countries, there are very large parts of the advanced world with debt to GDP ratios greater than 60%. So the question is, how can these countries adjust? Secondly, there's asymmetry. So there's a group of countries with debt above 60% and a group of countries with debt below 60%. And most emerging countries have debt well below 60% of GDP. So again, big asymmetries in the amount of leverage in the world economy. I'm going to have to move on a little bit here. One reason why I think there's weak global investment is because there's a combination of factors. One is productivity has slowed, and people were surprised at that. The expectations about labour supply changes have meant that future growth prospects are low because of labour supply, labour productivity, and there's just a lot of risk in the world. The risk comes because of, there's a lot of risk in the world, which means if you start at an equilibrium and you have these shocks impinge, what happens? Well, your capital stock is too high, and you have to get your capital stock down to a new equilibrium level. The way you do that is you actually have investment collapses, and then you depreciate yourself down to a new equilibrium. So it's not surprising that investment is very, very weak, because people had not apparently anticipated some of these big trends in the global economy. Secondly, there's a lot of risk in the world because central banks have distorted financial markets quite severely. So the asset pricing mechanisms that you'd expect to tell you what the value of something is are no longer determined by markets, but determined by central bankers. And also there's this problem with, because there's so much debt in the world, particularly public debt, someone's going to have to pay taxes at some point to service that debt, and who's going to pay those taxes? Why would you invest in productivity enhancing activities if you think the government's going to take away profits? The mining tax is one particular example of that, and the bank tax is another. So it's hard to see, given this world, that changing nominal interest rates really is going to offset any of these deep fundamental shocks in the world economy. So what I want to talk about is really, I'm not going to use monetary policy to solve the world. I don't think you can. What I want to talk about in the last 10 minutes is, well, given that world, what role can monetary policy play? What's the right framework? And the first question that comes up is, is inflation targeting useful? And my view is that you shouldn't look backwards, you should look forward. What are the shocks we're going to see? Disinflation came about because of the right monetary framework, but inflation shouldn't be the goal of monetary policy. The goal of monetary policy should be to promote macroeconomic stability. To me, that's the major issue here. So if you look at inflation targeting, there's a lot of central banks in particular, and I run into this when I make this sort of presentation at central bank conferences, is that it's always become a religion, that inflation targeting is the only regime that you should be following. And again, I thought it was a good regime when it was introduced by the Reserve Bank of New Zealand in the early 90s. I don't think it's still relevant. And if you look at the theoretical and empirical evidence, there's a lot of academic research which supports this proposition. So I'll just summarise very quickly and then talk a little bit about what are the key issues with inflation targeting versus nominal income targeting, which needs more research. There's a classic study by Ralph Bryant, Peter Hooper and Kathy Mann, which was published in '93 by Brookings, which took all the major models of the world and looked at all the different policy regimes that were possible, both monetary and fiscal, but focusing largely on monetary, to look at which regime dominated other regimes. And there was a paper which Dale Henderson and I wrote in that, which was also published with John Taylor's paper in the Carnegie Rochester Conference. They were back to back. Taylor argued for the Taylor rule. We argued for nominal income targeting. I guess we lost. That work really did set a standard for what we knew at that point in time. But not much has changed between then and now, except the state of the world economy. So the first question you have to ask is, what really matters to a central bank? What should matter? GDP per capita, consumption per capita, income per capita, wealth per capita, unemployment rate, inflation rate. My view is that what we care about is consumption per capita, and either wealth or income is a pretty good proxy for what you think will drive consumption. So inflation really has only ever been an intermediate target. You have to worry too if you're talking about targeting GNP versus GDP. And just for those of you who don't do international economics, GDP is the market value of the things you produce. GNP is the market value of the things you produce by domestic residents, so it includes factor payments from abroad and less factor payments to foreigners. So one is a measure of production, the other is a measure of income. In the US, the two don't seem to make much difference. Certainly when you do grad school in the US, you don't learn that there's a difference. But for a country like Australia, GNP is a much better measure of welfare than GDP. So why do I think nominal income targeting, and I'm talking about GNP, not GDP targeting here, why do I think it matters about the principle of targeting nominal income growth? Firstly, because what really is going to matter going forward is the ratio of nominal debts to nominal GDP. And so we're going to have to worry a lot. Central banks and fiscal authorities will be worrying about the sustainability of the debt to GDP ratio. So you want to have a pretty high growth rate in nominal GDP to ensure fiscal sustainability, as long as you've got the fiscal framework in working as well. And so I don't think inflation really matters. You don't want to have a low inflation world when you've got very high debt to GDP ratios. You have a central bank who's raising interest rates to bring inflation down at a time that you want nominal GDP to grow strongly, you could end up with a problem. So some of the key issues, one issue when people say, well, I prefer inflation targeting to nominal GDP targeting, the first issue is, well, how do we measure them and how do we understand them? If you're going to have a nominal acre, people understand inflation, they don't seem to understand what nominal GDP is. I disagree with that. I mean, inflation is an index that someone has to construct. Most inflation targeting central banks continually change the index that they're targeting because the index isn't doing what the central bank wants it to do. But nominal income is actually what we measure. Nominal income is what we observe We don't have to do any adjustment for indexes. It's something that we can actually, with big data, almost measure in real time. So it's something that, in fact, policymakers can see more clearly. And when it comes to expectations formation, people say, well, people understand inflation, we use inflation, it never changes. Well, the reason it never changes is because contracts are written in terms of inflation, and you're not allowed to change the inflation index because of all the legal implications. Actual inflation really does change, the measurements don't change. What basket of goods do you use? Whose inflation? Is it a CPI, a producer price index? Which measure do we want? There is also a lot of surveys, when you look at the surveys in most countries, people's expectations of inflation deviate for a long period away from actual inflation. So is it really a better nominal anchor than a nominal GDP target? Another advantage is it's closer to the actual target. Nominal income is closer to the actual target. The reason that people are targeting inflation is normally because there's an ultimate objective, which is some measure of well-being, which is more closely related to the nominal growth in the economy than it is related to inflation. Actually, most inflationary targeting regimes really do take into account fluctuations in real economic activity. So the Taylor rule balances inflation with a weight on inflation and a weight on output gaps. The Fed policy rule at the moment is really a nominal income targeting regime, but they're focusing mostly on unemployment at the moment. And even Australia, we have an inflation targeting regime, which is inflation targeting over the cycle, which is sufficiently ambiguous that the bank can get away with whatever it wishes to do at the margin. But in fact, it'd be nice to have a more explicit policy, because when you get hit with a shock, it's important that the market knows how you are responding to that particular shock. So this ambiguity that you introduce in normal times into these policy regimes, I think, can be costly when it comes to to these big shocks. Also, nominal income targeting works well with asset prices. If you look at the way in which asset prices will manifest themselves in the economy, they'll drive up income, drive up wealth, drive up consumption, drive up nominal income, whereas inflation may or may not capture the change in asset prices depending on how you've defined the inflation rate. Most inflation targets don't include asset prices, they're inflation of goods and services. Another big issue is how forecastable is inflation versus nominal GDP. And this is an open debate again, but most people who forecast inflation actually start by forecasting the output gap. They then use the forecast of the output gap to calculate their inflation forecast. What I'm suggesting is, well, you're going through the same process you need to get nominal income forecasts, so why don't we just forecast nominal income? And the evidence from the US, a recent paper from the US, is in fact there's a lot of bias in output gap forecasts. And yet I still need to see the data, but it looks like nominal income forecasts are less biased. They're not better, but they're less biased. And we need to finish? Okay. So let me just conclude. Let me just not skip the second last slide. I just want to be clear that nominal income targeting is not the same as a Taylor rule. Some people think, well, nominal income, let's call it nominal GDP, is GDP growth plus inflation growth, and that's the same as the Taylor rule. No, it's not, because the Taylor rule has a weight on output growth and a weight on inflation growth. What matters actually is the covariance between the two. When you put them together, the covariance matters. And so it may well be that it's easier to forecast nominal GDP because you're forecasting inflation rate, the output growth rate, and the covariance of output and inflation. In other words, if you have supply shocks, inflation rises, output falls, then the policy rule is to keep nominal income constant. That reaction to that is very different to a world in which you have demand shocks where inflation rises, output rises, and the covariance is positive. So this issue of is it a supply shock or a demand shock really matters. The bottom line is for emerging countries, most shocks have been supply shocks. For emerging countries, nominal GDP growth rate would have dominated inflation targeting regime. For advanced economies, it's ambiguous, but going forward, I think we're looking at supply shocks. So let me just conclude then. So the world economy, particularly Australia, is likely to be facing productivity shocks, commodity price shocks, global fiscal adjustment, changes in asset prices, shifts in risk premia, and shifts in climate policy that generate supply shocks. These are all supply-side shocks that are better handled by a nominal income targeting regime than an inflation targeting regime. So the key questions for researchers is really, and this is the final slide, is do you care about the level or the growth rate of nominal GDP? And that's a very similar argument to the price level versus the inflation rate. And if inflation, or if you choose inflation or nominal income growth, which one is better measured, which one is better forecasted, and which one is a better nominal anchor? And I don't have the answers today, but I think there's a lot of research to be done on this before we dismiss nominal income growth.
Right. Thanks, Warwick. That's great. Very disciplined. A couple of quick questions, though, for Warwick-specific presentation. You mean in terms of measuring it, or in terms of reacting to it? Well, again, it depends on what your ultimate. I'll stand up there. 1, 2, 3. So cut it off there. Depends on what your. I don't have a microphone. Depends on what your ultimate. Thank you. It depends on what your ultimate objective is. I think if you reran history. With the commodity price shocks of the last 10 years, you would have been better off with a nominal income target than an inflation target. Now, the GDP deflator is different to the GNP deflator. So I'm not talking about nominal GDP targeting, I'm talking about nominal income. So I'm talking about nominal GDP. Secondly, the CPI has moved around in very unusual ways depending on whether you have housing in the CPI or not in the CPI. So, but it is. I agree. It's an open question. The things to be done is to rerun history and see which one works better, which we're doing, but we haven't finished that. But I think it all comes down to which is the better anchor, which is the better automatic responder to shocks, and which gives the best clarity to the markets on how the central bank will respond. Another question there, and then third question there.
Some people argue that they're in search of a natural cash rate or natural interest rates as an alternative. I just wanted to know your opinion on that.
Well, again, this is like trying to calculate output gaps. Is you have to have a particular view of the world to be able to do it, and you'll get very different numbers. My simple rule in a nominal income framework is that neutral monetary policy is when the cash rate is equal to the nominal growth rate of the economy. There's been no deflation done. There's price changes in both sides of that. But if I was trying to say what is a neutral interest rate, I'd say, well, in Australia, it'd be the nominal growth rate. Now, today, the Australian economy's nominal growth rate for the last 12 months has been 7.2%. The interest rate, the cash rate, is 1.5%. I would argue that we have extremely loose monetary policy today based on this general rule of thumb. I'm not saying there's not lots of problems in the system where raising interest rates will cause real problems. I think there are, because I think our interest rates have been too low for too long and we've distorted a lot of capital allocation.
Final question there for the moment.
Warwick, is that turned on?
Yep.
It strikes me that you and Scott Sumner are attacking a straw man. That I can see fairly strong arguments why nominal GDP targeting is going to be better than being an inflation nutter. But Australia and the United States have dual mandates. My sense is that other central banks do, but they don't admit it. The real alternative comparison is not between is not really pure inflation targeting. It's pursuing a dual mandate, and I think that's sensibly and appropriately dealt with by optimal control.
Okay, so in a sense, it's very similar to what is being done. What I'm thinking about, what I'm worried about are the extremes. The extremes are, for example, if you've got an inflation targeting central bank and you need to get real interest rates to drop sharply like we needed in the US and in Japan and in Europe, if you have an inflation cap of 2%, inflationary expectations can never rise to 4% because you believe the central bank will never let that happen. So in the extremes, when a big shock comes, you cannot get the real interest rate down low enough in a pure, even in a trade-off world, because your inflation target dominates. In a nominal income world, if growth falls to 2% and your target is 6% nominal growth, people realise that you're going to let inflation rise to 4% and you can get real interest rate movements. In emerging countries, the difference is dramatically different. And what worries me is the IMF and others going around telling emerging countries to have an inflation target because they want central bank credibility when their economies are riveted by supply shocks, and all they end up doing is tightening monetary policy when inflation rises because of a bad harvest and crushing their economies. So there's a whole spectrum globally. It is unambiguously clear for emerging countries nominal income targeting dominates. When it comes to us, it's to Australia, the US, New Zealand. It really does depend on if a big shock comes, how will the central bank respond, and how credible will the inflation target bind expectations so that you can't get enough real interest rate reduction. So I take your general point, but I think it's a bigger issue than that.
Great. Great, thank you for that for the moment, Warwick, and we might have some more time a little later. Now for Guy Lim to present for us, please. Guy is Professorial Research Fellow at the Melbourne Institute of Applied Economic and Social Research, and also an adjunct professor in the Department of Economics at the University of Melbourne, and she's currently heading the macro program of the Melbourne Institute. So please, Guy, over to you.
Thanks, Glenn, and thank you for the organisers for inviting me to present at this session. I think you're going to find that there's a lot of similarities between our main themes, but what I've done is to organise my presentation around the question, why is growth low, and what can, particularly short-run policy, do to stimulate the economy? So in this regard, I've organised my presentation around 3 points. The first is to just look at some empirical evidence of low growth and low interest rate. So you'll find that whatever slides I put up should be familiar to you. Then I'm going to discuss what appears to be the case, that monetary policy is ineffective at this moment. And I will then sort of talk about the hypothesis around secular stagnation, savings glut, and this concept called the natural rate, which the Reserve Bank actually talked about in their last minutes. And the last thing I'm going to do is that all these points should lead to the discussion that we need to think outside what we're doing conventionally now. And in particular, it leads to a discussion about unconventional policies, in particular unconventional monetary and fiscal policy. So without further ado, sorry, what did I do?
Use the arrows.
Oh, thank you. So down? Okay. So the first slide is just to show that what motivates the discussion around growth. As we can see, GDP growth fell during the GFC, and despite policies around the world to stimulate growth, there's very little signs of a strong pickup in growth. Right? In Australia's case, I found this a very compelling picture. The cash rate has been coming down quite a lot. It plummeted post-GFC, and from the high point in November 2010, when it was 4.75%, it's now dropped by 325 basis points to be 1.5% now. So in total, I counted 12 rate cuts, 11 at 25 basis points, and once in May 2012 by 50 basis points. But what is startling about the picture is that despite the fall in the interest rate, and it's pretty low now, and it's been coming down for quite some years, over 6 years in fact, there's actually very little signs that growth is picking up. And all I did was just do a crude average around the periods before the GFC and the periods after, and it will appear that we are now running at a growth rate which is below trend, i.e. in comparison to what it used to be before 2008. So the question then becomes, is this the new norm? We need to think a little bit more about the role of monetary policy. But before we do that, I should just show you 2 more pictures. The first one is the fact that despite our monetary policy, inflation is still below the target range, and it's been languishing at that level for quite some time. The key idea here is that when you translate that to the real interest rates, we get a picture which shows that the official real and cash rate, so all I've done there is take a simple calculation, the cash rate less the underlying inflation, so I did it the absolutely simplest way. You see that the official real cash rate is coming down quite a lot, and in fact, there are periods when it's below zero, right? So all this would seem to suggest that if we think where our heads as a policymaker, that perhaps there's something not quite right about monetary policy. Has monetary policy lost its effectiveness? Are we in a period of liquidity trap? Is dropping the interest rate not enough to change people's patterns of behavior? So when I started looking at that, I started to think, all right, so what is going on? So as usual, you look at the literature, you look at what's happening around the world, because this is a common phenomenon that's been, it's quite prevalent around the world. And the key explanation I've found is that we need to think about secular stagnation versus the savings glut, and this concept called the natural rate of interest. So what is this natural rate of interest? Okay, I'm going to read the definition because there's slight variations around the literature, but it pretty much all say this. The natural rate of interest is an unobserved, theoretical rate. It is defined as the real rate that equates desired savings and planned investment by rational optimizing agents, and such that output is at potential and inflation is stable in the long run. I noticed in the last minutes of the Reserve Bank that they actually calculate what they call a neutral interest rate. So it's the same concept, the neutral interest rate, equilibrium interest rate, natural interest rate. These words have been used interchangeably. But effectively, it's the rate where we can say the economy is working at full potential and inflation is stable. Okay. The concept can be traced way back to Wicksel's days, but the concept that's sort of popular and that has been sort of advertised a lot is actually by a group of economists, Holson, Lorbach, and Williams. Williams and Lorbach actually started research quite some time ago, and they had the first go at estimating the natural rate. Now, I put up equations there just to show you that, the idea didn't come from, nowhere. There was actually some thought that went into the idea and some effort to sort of calculate or extract the underlying real rate such that output is at potential and inflation is stable. So to do that, they had to sort of come up with some idea of what the equilibrium rate is, some idea of what, what it means to talk about potential output and what it means to talk about stable inflation. So I put equations there if anyone wants to follow through it, but the intuition is straightforward. Find the natural rate, find the rate such that output is at potential and inflation is stable. Now, I believe that that's what the Reserve Bank did when they computed the natural rate too. But for those of you who like to sort of play around with econometric models, you can certainly extract a natural rate if you use state space estimation, which I tried to do, and I'll come to that in a little while. But just to continue the story, if that's your concept of the natural rate, and it's the rate that you wish to get through, and that's the rate that the monetary policy should be aiming to get through, then you start thinking of what are the drivers of the rate and whether this, monetary policy is not as effective nowadays because the rate is too high. So the argument goes that although you might have lowered the nominal rate is 1.5%, it might be that it's not really low enough. That at the rate we have today, there might be just not enough savings and too much savings and not enough investment. So in short, if you look through the arguments about secular stagnation and savings glut, what is defined, the message implied in there is that we are in a liquidity trap because there's too much savings and insufficient investment. Okay. So I had a quick look at the data, and this is the picture about household savings rate ratio. It would appear to be the case that the savings gone up, it's kind of flattened a bit, and superficially it would look as if we have too much savings. If we look at the investment picture, I was quite surprised to find that the huge gap between consumption's contribution to growth and investment contribution to growth. But of course, if you dig deeply into the story, you know that it's because we're coming off a mining boom, and so the non-mining investment has to pick up. But in the meanwhile, that's the story. So superficially, it would appear as if that we have too much savings and not enough investment. And perhaps, there's something to be said about this secular stagnation and savings glut story. However, being a quantitative type person, I decided to estimate and see what the natural rate would be. Well, according to my first pass estimation, I've still got to do a lot of work to make sure that my estimates are robust. It would appear that the Reserve Bank's rate is close enough to the natural rate. In other words, policy is actually about right? And I was happy to sort of find that my number here is very close to what the Reserve Bank reported in their minutes yesterday when it was released. Yeah. But if that's the case, that the monetary policy is sort of operating at where the natural rate should be, then it kind of leads to the question, so what else should we be doing? And this is where we need to start thinking outside the square, outside of what we conventionally do. And so we will start thinking, so let's start thinking about what we mean by unconventional monetary policy and unconventional fiscal policy. Unconventional monetary policy became quite prominent, post-GFC. And Bernanke took great pains to ensure the general public that what he was doing is not the same as what Japan was doing. Okay. What the US is doing wasn't quantitative easing. Let me back a bit. Quantitative easing is such that if you change if you implement it, what you're doing is you're introducing extra reserves into the system. Right? Credit easing, as Bernanke took great pains to explain, was that basically you're changing the profile, the asset profile. Intuitively, what you're doing, the Fed's doing is they're buying the bad debts and putting back what they hope is sort of less risky assets. So by changing the profile of the securities out there, they hope to influence the spreads. They hope to sort of make the banks feel and the borrowers and lenders feel a little bit more happier with the system, change the credit profiles, and therefore encourage more lending. Well, that was the scheme. Well, for Australia's case, we're not actually at the zero lower bound, even though we're quite low, and superficially, I would say that that's not our issue at the moment. So, but nevertheless, the Reserve Bank's hands are a little bit tied at the moment because they are quite concerned about lowering the interest rate further because they're a bit concerned about what it means for house prices. So that then leads to the question of what about the fiscal side of the equation? Now, unconventional fiscal policy became actually prominent with Feldstein's work, and the theory behind his work was picked up by Fahy, Correri, Nicolini, and Tellus. So that's the theoretical paper. The unconventional fiscal policy there is actually about not being to change interest rate. And so what can fiscal policy do to actually bring about, stimulate growth? And what they specifically discussed was actually changing the tax policy. I know we're not popular to talk about GST here, but effectively what those papers are saying is you should try to think about changing the consumption tax because that will mean that the householders would start spending now. I'm putting it in very simple terms what they are trying to say. They will start spending now in anticipation of an increase in prices later. To compensate for the increase in the GST, what they also suggest is that you lower the income tax. So by a combination of taxes, they hope to incentivize the householders to spend. And the idea, if you spend now, you would also stimulate the economy, increase growth, and in the process, that means whatever concern you have about debt and the deficit will actually start to fall. Because as we know, if your economy grows, and employment picks up, unemployment benefits fall one side, and tax income rises the other side, so deficits start changing into surpluses. So the theory there is quite specific, right? And so that leads me then to sort of saying, all right, if we need to think about unconventional policies, how would interaction between unconventional monetary policy and unconventional fiscal policy work? And so very quickly, Paul and I started to look at this issue. And so we did a paper where our aim was to understand the interaction between unconventional monetary and unconventional fiscal policy, but in an economy where it's highly integrated. Right? Like Warwick, we think that you need to think about Australia as part of the global economy. So we did that, and for anyone who wants to follow up the literature, the reference there is the work by Dolido, Carradi, and Lombardi, a JME paper. Very quickly, a couple of minutes. So very quickly, what we did was we set the scenarios so that there are two types of shocks. Remember, the productivity shocks is an issue at the moment. And the other shock that we did was an incentive shocks, because in some sense, the consumers are not spending because they're not that confident that the world is less risky. So they're all spending savings more than perhaps what theory would like the reserve banks and central banks would like them to do. So we did these two types of shocks. Again, I've put up equations there just to show you that we didn't plug the numbers from the air. You actually had to sort of think through the model. And this is quite an interesting model to work with because there was a lot of care to sort of model the credit easing that Bernanke was talking about. And in terms of the financial leverage, what it allowed us to do was to change the alpha, which effectively links the behavior of the households to the banks. Now, I don't have enough time to actually go through the model, but I would just like to point out that the model is structured so that it also highlights the role of the spreads. So the model now has the elements that we're interested in. A productivity shock, the financial incentive shocks, which sort of underpins why consumption spending is a bit low. It has the interaction between the households and the banks so that we have some idea of, how once you lose confidence in the system could collapse. Right? And so we've played around those two shocks, and what the policy scenarios we played with was the QE, or credit easing, to use the correct words, and the tech shocks. Okay, so the policy scenarios we played with was the base case, no policy in both countries. Country one, we fix it so that they only adopt QE, like the US, just adopt QE. And country two could choose to do nothing, or else they decide to implement unconventional fiscal policy. In terms of the results, we presented in three ways. The impulse response is a normal way we present results, but what we did too was we also simulate the model for thousands and thousands of shocks. And part of this was to get the distribution of outcomes. And the last way we presented results was we zoomed in. And I've learned this fancy words that people use to describe when you zoom into an event. They call it the dark corner analysis. So I'm going to show you some dark corner analysis. Okay, impulse response is sort of familiar to everybody who sort of works in macro. But the message I want to get across there is that depending on the shock, your shock and the other country's shock, the outcome is very different. And there's some sort of ranking of outcomes. Right? So if productivity shocks, if it happens in both countries, that's a blue line, you'll have, in all cases, because it's a negative shock, you have a worse outcome. However, if there's a financial shock in country one, and these are impulse response for country one, but the other country has a productivity shocks, you actually, the outcome is that you benefit, right? And that's because the nature of the model is such that if they've got a really bad shock in one country, the banks in that country have the option of sort of lending to another country where the risk is less risky. So, in other words, the interconnectedness of the world through trade and financial links have been modeled. So that even if you as a country is suffering from a particular bad shock, if the other country's shock is worse than you actually benefit. All right. The distribution is to just sort of say whether if you go beyond one shock and the country is subjected to a stream of shocks, which is normally what happens rather than the one shock, then what would the results look like? What we were looking for there was the sense in which the tails of the distribution were affected. So the blue line is the normal distribution. And what you can see from the red line is that if both countries are subject to pretty bad shocks, the tails of the distributions are severely affected. And effectively, what it means is that we can have a little bit of confidence that our simulation is of doing the right thing. We've increased the probability of having bad outcomes. Right? Time to worry about 2 more slides, that's all. Okay, the last one is just that we zoomed into the sort of analysis during crisis point. The crisis is defined here as the case when the economy collapses, But by construction, the economy collapses and it picks up. So the blue shaded area is all the sort of outcomes around that point. Collapse of the economy and up, and there's no policy. The red line there is when country one implements QE, no matter what the type of shocks is subjected to. And the green one is when the other country implements soft tax policy, fiscal. All right. Now, I don't have time to go through all of the results, but what you get there is the message that you really need to know what the shock is as to the appropriate instrument, the policy to use, and that there are times when you benefit, and there are times when you actually make your outcome worse than if you had not done nothing, right? So I can't actually point. So there are cases when you see the green line is below the blue line, meaning it's a worse outcome. You're better off doing nothing, right? And there are times when the red line, the green line is above, meaning that your policy has succeeded in lifting the worst outcome. All right. So I'm going to, I guess, you want me to conclude? All right. So to conclude, so I've organized my presentation around 3 points. The first point was just to present some evidence that growth in Australia is low and that the conventional use of monetary policy as a stabilization tool appears to be ineffective. Well, we seem to be kind of stuck at the low point. So then the second one was to understand why we seem to be caught in a liquidity trap. And in this regard, I considered the arguments around secular stagnation, savings glut, and the natural rate of interest. Although there is some evidence that savings is perhaps too high and there may be not enough investment, there's actually very little evidence or strong evidence that the actual real cash rate is very different from the natural rate. If that is the case, then what it means that we need to think beyond the conventional approaches. So the third point, my third point was to consider the role of unconventional monetary and fiscal policies. I know that Peter is going to pick up that story, and for that reason I went into the description of a little simulation exercise that I did with Paul. And effectively there, what the simulation exercise showed was that if we broaden our thinking to go beyond the conventional, it's also necessary for us to broaden our thinking to be aware of what our neighbors' policies are. Australia doesn't exist in a vacuum. If we don't take into account our neighbors' policy, what the simulation shows is that we actually risk being worse off than if we did nothing. Thank you.
Right,
Thank you.
Very stimulating presentation. Thank you so much. One or two questions to keep to time and allow for some general discussion. One here. Oh, can people identify themselves too, thanks to the extent they're willing to?
Hi, Chris Perks from the Commonwealth Treasury. That was a fascinating talk. I just wanted to be sure that I understood you correctly when you were saying unconventional fiscal policies. So basically you referred to an example. The example was the GST, and the example you also, the pair of that was income taxes. And so basically when you say unconventional fiscal policies, what you're suggesting is that you have tax rates, GST tax rates and income tax rates that vary with this or respond to the state of the economy. First of all, is that correct? And second of all, then that would require a pretty substantial remaking of our institutions as well. So when Warwick talks about nominal income targeting, this is something that really could be done through perhaps some changes at the Reserve Bank level, whereas what you're suggesting on the other side of it would really require a political class to relinquish controls of tax policy and perhaps vested in the hands of an independent agency, which is a substantially dramatic change.
Yeah. Yes. Yes. Can you hear me? Yes. So the theoretical literature assumes that these things are going to happen. And I had the good fortune of sitting next to somebody from the Treasury who basically told me this is not going to happen because there are too many issues. I think she's also used the word the relationship between the Commonwealth and the states will complicate the issue. But she did say one thing useful. She says, if academics keep putting up solutions or keep showing examples where it actually makes sense, right, then it will give her some arguments to persuade our political masters that is actually a policy that's worth thinking about. Yeah.
That's just a clarifying question.
Yes,
Oh.
Warwick?
You made a comment, Guai, when you calculated the natural rate of interest,
Yes.
that the Reserve Bank was about right. You mean their calculation is about right, but their policy rate is much, much lower than the natural rate because you have to add the inflation rate to that 1%.
Oh, yeah. So that's what they were talking about, 3.5.
Yeah, right.
Yes.
Right, okay.
So I think that means they were thinking about one, and I think mine was about 0.75, so around, they're about the same.
About the same,
Yeah,
okay.
the reported number in the minutes is the nominal rate.
Okay.
Yeah.
Okay, we'll move on now to stick to time, be close to time. So, Peter, your turn, and Peter is an economic consultant working with Applied Economics. He's held chairs in economics at Macquarie University and Sydney University, lectured at Sydney University, and also has a public economics textbook that if you all assign it to your students will be a best-selling textbook. So you should have a good look at that.
Where does,
Bring it back
no,
one.
it doesn't matter. Okay, thank you very much. Now, I've got a full copy of both the PowerPoint and the paper itself, so which is available here if you want to after I spoke. Actually, I'm having an interesting discussion with McGraw-Hill at the moment because they're not selling as many copies as I would like, and I've suggested to them that they revert the author's rights to me, because actually I would like to put it up on a website and make it a free good, and then people can, we can gradually increment it and update it. Apparently there are about 10 people who have to sign off on this at McGraw-Hill, and it's taken 6 months to negotiate it so far, but I'm hopeful it will happen, because I would like to make it well available and to update it regularly. Anyway, yes, I'm going to talk about rebalancing monetary and fiscal policies based on the key issue, does poor economic performance reflect, in part at least, of course there are lots of causes, we know that, but in part at least on inappropriate macroeconomic management, and more specifically, over-reliance on monetary policy and underutilization of fiscal measures. I will aim to complete in about 15 minutes because the paper and the PowerPoint's there, and I think people here in the room might like to make comments generally about any aspect of it. So that's how I will proceed. I examine these issues in this paper with special reference to the Australian economy. The paper outline, firstly, it discusses the international Australian context, then some recent reassessments of the role of fiscal policy, and I should say that most of what I'm going to say here today has already been said by the IMF and the OECD, strongly advocating these policies, and the fairly voluminous quotes from them in the paper, a bit about the interaction between fiscal and monetary policies, which isn't particularly necessary for this kind of audience, the costs of over-reliance on monetary policy. Then I do have to discuss the government accounting guidelines in setting fiscal policy, because unless we have proper accounting processes, any fiscal rules are meaningless. The concept of fiscal space, the amount of public debt that can be tolerated, and here I'm going to disagree a bit with Warwick, I think, because I have a much greater tolerance for public debt than I think Warwick was implying, but I may be right. Briefly on selection of public investments, fiscal rules, if you're going to have some form of fiscal discipline, you want a fiscal rule of some kind, and some conclusions. Well, this is the problem, of course, that since 2008, we've been growing at below our trend line significantly. America more so, Europe, of course, probably even more so. And the question is, what drives that, and what can perhaps restore it to a trend line. I don't want to put all the blame on macroeconomic policy, but this paper does also address some issues of productivity as well through the fiscal approach. So obviously, as most people know here, monetary policy across the world has been highly accommodative since the GFC, particularly in the developed countries. Nominal interest rates reduced to effective lower bound, and unconventional monetary policies employed in the sense of quantitative easing, and particularly in the UK and America. Curiously enough, fiscal policy, which was accommodative initially, has tightened in many countries who have been concerned about the size of sovereign debt. Public investment expenditure, particularly by cutting in public investment spending, which is easier to cut than recurrent spending, despite borrowing costs at all-time lows, around 0% in real terms has been pointed out, and arguably infrastructure deficiencies holding back growth. Again, the OECD report cited there supports that, or advocates it, I should say. We in Australia have relied heavily on monetary policy, of course, to support demand, particularly after commodity prices softened in 2011. And except for 2009-10, fiscal policy has been slightly pro-cyclical. In other words, fiscal policy tightened in years when output gaps suggested a slack in the economy. And again, the IMF report cited there, I quote that in support of that comment. Many parties have argued for a more active fiscal policy. Basic points include exhaustion of monetary policy. There is fiscal space. Fiscal policy is effective, and more public investment is needed. That's been sort of the core argument. Academics like Roma, DeLong, Summers, Furman, international institutions, the IMF and OECD, and as a matter of fact, central bankers Bernanke, and even in our paper we quote ex-Reserve Bank Director Philip Lowe, are all essentially arguing those kind of points. Our situation here, well, we haven't reached quite zero nominal lower bound like perhaps the US and the UK have, but in my view, and many points, we've reached the point of limited effectiveness on demand, that lower interest rates anymore, it's not going to promote private investment. Obviously, the point's been made, lower interest rates would risk excessive household debt, indeed, if we haven't already got to that point. Given low inflation, fiscal expansion doesn't have to lead to monetary tightening, so we could have fiscal expansion without necessarily raising interest rates, which wouldn't be the case if we had a more inflationary environment. Private investment is held back by a lack of demand and confidence, clearly not by high interest rates. And increased public investment, in the judgment of the paper anyway, wouldn't lead to much crowding out of private investment. What are the costs of over-reliance on monetary policy? Well, everybody's been talking about high house prices across. Now, the interesting thing about house prices is they've been entirely across Australia. Since 2003 to 2016, house prices have risen just as much in Adelaide and Perth and Melbourne as they have in Sydney. And secondly, house supply has not fallen behind population. The population increase between 2006 and 16 was actually slightly lower than the housing supply. The reality is that the house price increases are almost entirely due to lower interest rates. In 2016 dollars, interest payments on an 80% loan for median houses were lower in 2016 than they were in 2002. Financial stability, that's already been mentioned, it's well known, increased household debt, volatile asset prices, arguably flat yield curves and weak intermediation process could impact on bank profits and security. Inequality, especially via asset prices and wealth effects, the wealthy gain from low interest rates because of asset price increases. On the whole, low-income people don't benefit much from the low interest rates, whereas fiscal policy can be clearly redistributive and invested in skill developments. And an argument of the paper is that more emphasis should be in that area. So monetary policy is at the best neutral, possibly worse for inequality. The argument of the paper says worse. Fiscal policy can go the other way. And industry adjustment can be harder with over-reliance on interest rates because you get volatile asset prices, house prices fly up, construction industry goes gangbusters, and then of course it falls off. And the impact on asset prices and exchange rate does make things a bit harder for industry adjustment. Now, as I said, we do have to turn, if we're going to move more towards fiscal policies, we do need to understand what the sort of basic accounting rules are. As I mentioned, the IMF and OECD recommend increasing public investment funded by borrowing debt to be more counter-cyclical, but with restraint exercised for current government spending. So that means we need to be able to account accurately for capital and recurrent forms of expenditure. Now, in the latest budget, we did move part way towards this because the Commonwealth budget distinguished between underlying cash balance, net operating balance, and adjusted net operating balance. Our net operating balance takes out the capital expenditure by the Commonwealth. The adjusted net operating balance, the adjusted one, actually takes out grants to the state for capital purposes, which actually is really capital expenditure, albeit by the states. So that, in a sense, is the most relevant benchmark. On the basis of that, the adjusted net operating balance, Commonwealth now has a very low budget deficit of only 0.4% of GDP. There's a table in the paper from the Commonwealth which gives all that data. There are, however, ongoing issues with government accounting. These developments are welcome, but they're not sufficient. We still have a bias against public investment. Why? Government retains the underlying cash balance as the primary measure for meeting objectives of returning budget to surplus. And that includes capital expenditures. Secondly, some recurrent expenditures are essentially capital investment. Notably, education. A large amount of the money we spend on education is actually capital investment, and some health and certainly asset maintenance are really capital expenditures. So, firstly, we've got to get our budgets right and be meaningful about capital expenditure. And then, if CapEx is excluded from the target, the budgetary target, there needs to be a strategy for the appropriate level of capital expenditure. So if we have a recurrent balanced budget target or whatever, we need then a strategy for the appropriate level of CapEx. Of course, there is a problem with federal state funding. I mean, if we start saying that taking out the capital expenditure grants to the states and then the Commonwealth Grants Commission puts them back in again when it redistributes money back to the states, that's a bit of a nightmare. But anyway, that's something we have to deal with. But the basic point is we need to get our accounting structures right. And then once we've got it right, we then need to have a target for capital expenditure. Turning to fiscal space, as most people know here, is the distance between current debt levels and the debt limit beyond which borrowing is not sustainable or the economy is unstable. Again, there are many articles on this. They're cited in our paper. Basically, very low interest rates increase fiscal space because they clearly reduce the real cost of debt. The key issue is fiscal space depends upon the differential between real interest rates and the rate of output growth. If the economy is growing, of course, then the debt to GDP is not going to grow. It's going to be stable. Productivity, and the paper argues, and OECD and IMF have argued, that productivity enhancing investment increases fiscal space. And clearly debts in the local currency are lower risk than debts in the foreign currency. So the IMF and the OECD, and I would agree with that, my co-author would, there is plenty of fiscal space in Australia to justify more reliance on fiscal policy, especially public investment. We have a projected net debt at the end of 2017 of 21% of GDP, compared to the UK 80%, US 82%, Japan 120%. The figures you show were gross debt, of course. I think Japan was gross debt. OECD paper a working paper by Fournier and Fall, is a member of the OECD, estimate our debt limit as high as 250%. Even Moody's, and you can't claim that they're other than conservative, say that we have remaining fiscal space of 215% of GDP. The OECD has a lower range of 120 to 160% of GDP, but I mean, obviously that's magnitude's difference from where we're standing or sitting at the moment. The last two sections are about how we select public investments. The difficulty is that basically the government really has to determine the level of public investment first. We can't have a bottom-up approach using CBA in all projects because we simply don't have a world of perfect information. However, in our view, and probably most people's view, cost benefit would remain the instrument and discipline for selecting projects within this macro setting. So the case for increased investment certainly doesn't imply selecting poor projects. And that means the real discount rate, oh, it's gone, crikey. Sorry, I was unaware of this. I think I'll carry on. The real discount rate would vary with the chosen level of investment over the business cycle. But I would add, so it would go up and down, the discount rate using cost-benefit analysis. However, if there were insufficient public projects, we wouldn't recommend investing in the public sector at a lower rate of return than you get in the private sector. So if you didn't meet those benchmarks, essentially the benchmark would still be the rate of return in the private sector, and you would invest in financial instruments in the private sector if there were insufficient, really good public projects. Not much point doing this. Now, this is a little bit of a problem because how do you set a fiscal rule for the budget? And I actually have an equation here, and I can't talk through the equation. And let me just say one or two points about principle. The fiscal rule would specify the structural or average level of public investment over the cycle. It will provide for systematic variation around this, obviously with higher target in downturn and lower investment when the economy is strong. It does need to be reasonably objective and robust to public pressure, and it does have to have a proper accounting framework. I'm afraid that I'm not going to be able to talk about the fiscal guide because if we just do. Nothing's come up. Look, it is written out in full in the paper. Basically, we're saying that the public investment should vary, deviate from the real on the basis that the relationship between real interest rates and the economy and some form of average or neutral level. I think it's going to be possible to explain it without using the equation. So let me just, it is in the paper, let me just go to my conclusions then. The paper considers the case for a more countercyclical fiscal policy, particular focus on higher public investment. It argues there's been over-reliance on monetary policy, and that has contributed to poor growth, also contributed to issues of housing affordability, inequality, and risks to financial stability. And okay, how am I doing for time? Can I go back or what?
You've got a couple of minutes.
Okay, well, so the possible fiscal guide is that a rule that varies public investment according to deviation of real interest rates from the average or neutral level, where A would be some form of parameter for the average level of gross investment over the cycle, B would be the countercyclical parameter, and that would vary with the difference between a neutral real interest rate and the current real interest rate. So if the neutral real interest rate is higher than the current real interest rate, you would raise investment. And if the current real interest rate was lower, then you would raise investment. If it was higher, you would reduce public investment. That's one of the concepts that's been talked about in the literature, which we talk through. But I think that I just make the point make the point, the final point here, that in practical terms, that could be a strategic guideline to an efficient level of public investment within an efficient macroeconomic policy. Wouldn't expect it to be a mandatory or binding target for government, but it is put forward as a possible fiscal rule. In the literature, there's a lot more other fiscal rules that could be considered. So just in conclusions, we argue for a much stronger counter-fiscal policy, that the supportive fiscal policy can complement monetary policy. It could crowd out private investment by improving demand outlook, but that obviously is when you're at a high level of capacity. Low interest rates strengthen the case for public investment funded by borrowing, and that's the fiscal gap, and greatly increase the fiscal space available to us. We do make the point in the paper that education and infrastructure are really important forms of investment in the future productivity, and structurally higher levels of spending in these areas could be considered as investment, although obviously that's a very difficult issue as to what you can do objectively and so forth. But we really need to distinguish very clearly between recurrent expenditure and investment, and the new emphasis on net operating balance, or the adjusted one, is particularly welcome but needs further work. But we then need to get a fiscal rule around that, when a rule is suggested in the paper, but that would, we're not going to say it should be mandatory, but it certainly would assist government to achieve a public investment profile that's more appropriate to the macroeconomic context.
Right, thank you, Peter. Very, very comprehensive presentation, so I'm sure there's plenty we can ask. A couple of quick questions here and here for Peter, and then we'll open it up for general discussion, beginning over here with the colleague from Treasury. So after
Peter,
these two, we'll open it up.
Peter, Department of Planning. I'm a bit out of my jurisdiction here, but just wondering about the idea of going to that level of investment, say to 250% of
That's debt. That's a stock figure.
Oh, okay, yeah,
not a flow figure.
And the income that needed to repay that. So I'll come back to how the interest rate in your equation is linked to sovereign debt, sovereign risk, and therefore the credit rating, and therefore the interest rate risk premium that would pay as we move towards such a high level of debt per GDP.
Well, I was really citing other authorities had reached that kind of figure, but clearly if your debt is denominated at 3% in a local currency, it's quite different from its 5 or 6%. You can go basically to twice the debt level. And also, of course, if it's entirely denominated in local currency and you don't have inflation, then you don't have a sovereign debt problem that you do if it's in foreign currency or an exchange rate risk.
Abbas Walatkani from Swinburne University. My first question is about, the debt level that you were talking about, Peter. I think at the moment, every month we pay $1 billion interest on the accumulated debt level that we have, given the very low interest rate. Now, if the interest rates happen to go up, that level could be $1-2 billion every month that we could have built the schools, and there are, the intergenerational theft. The second point that I just wanted to have is relate to the Warwick's argument, and I totally, one other argument that in support of your view is that we have reached that low level of cash rate that, everybody knows that, the bulk of the consumer's expenditure goes to the mortgages. The very moment the mortgage interest rates go up, is going to have some impacts on inflation. In other words, we cannot afford to be reactive to the inflationary pressure. We have to be proactive and consider other measures, not just inflation.
I'll just respond very quickly to your first point. The point is that, of course, Morrison, our treasurer, uses this rather nasty term, good debt and bad debt, a very unfortunate term. But this debt, of course, is to be accrued against investment, which is supposed to give you 5, 6, 7, 8% real rate of return. And it's in that context that you can take on a higher debt more than if you're just borrowing for recurrent expenditure.
Warwick, do you want to address address this one? We're beginning to open up the general discussions.
Well, yeah, just the general point is that the way I think about it is I'm happy with debt that has an asset next to it. I'm not happy with debt that has no asset because then that's implied future taxes.
Yes, sure.
And so just to clarify, that's the better definition of good and bad debt.
Okay, we'll open up for general discussion, starting over here. 1, 2, 3, 4. That's 4 so far. 5, okay.
Thanks very much, Peter, for your discussion. And I guess this might be an apt place to begin because what kind of twigged with your discussion was something very similar to what twigged for me in Guy Lim's discussion, and that is really that the devil is in the detail. So when Guy Lim was talking about the unconventional fiscal policies, my comment was, well, how implementable is this? I thought you made quite a good case for the fiscal space, but then when we got to the point where you're saying how this could actually be implemented, then the discussion for me seemed a little thin. It was public infrastructure and then investments in financial instruments. Now, the first part of that, there's not a lot of specificity around it, and the second part of that sets the alarm bells ringing because what does financial instruments actually mean? Does this mean equity investments in shares on the stock exchange? Does this mean buying the corporate paper of some company? And so I guess what my concern is really, having gone this far to make this argument, the devil is in really how could the policymakers pull this off in a way that's not going to lead to bigger problems or alternative issues in the future?
I accept that view in the sense that, finished writing this paper on 2 days ago, and this was the last part. I mean, the governments do invest in the private sector. There are two points. I mean, the Future Fund invests quite largely in the private sector. So the government does, in principle, have agencies which does that. And secondly, we do want to keep discipline on rates of return on public projects. If you're only getting 3% in the public sector and you've got 6% in the private, then that should be an alternative. In fact, that's a strong alternative. And that was really what we didn't necessarily want rates of return to be, in order to use the, we want to focus on investment, but we don't want to do it so that we are investing in 3% in the public sector when you've got 6% in the private. That was really the point of principle we were making, but I accept that the paper does need, or Treasury needs, if they're interested in getting more, using investment more as a fiscal instrument, which the paper argues you should, the practicality does need to work out. But I'm fairly sure you could reach, I agree, putting education in there is difficult because how much and so forth. But I think basically you can reach some practice. There's a lot of discussion about fiscal rules in the literature.
Someone come in?
Well, I just wanted to sort of make a philosophical point here. I mean, the question is, what is the market failure that the private sector is not coming in to deal with the issues that you raise? And, government coming in and picking it up at the end is, to me, second or third best. The market failure to me in Australia is that the government and opposition have no commonality in their policy frameworks whatsoever. And so therefore there's a lack of any incentive to invest by the private sector because you don't know what the tax policy will be. You don't know whether there'll be a mining tax, a banking tax, a software company tax, a university tax. You really don't know. So the private sector's not out there investing, in my view, because of all the risk generated by the political uncertainty. So I would first best want to clean up the incentives generated by the politicians before letting the politicians then come in to fix up the market failure that they've created in the first place. So I have this deep fundamental problem. There is a role for fiscal policy. There is a market failure in the sense infrastructure has social rates of return, which you do want to internalise, and there is a role for government in doing that. But as a general principle, the government can fix this. I have a problem with that philosophically because I think government is creating the problem, not government, but politics is creating this problem in our country and other countries. We have the Trumps, we have the Brexits, we have policy frameworks falling apart. That's why you're not getting investment.
Well, Well, the thrust of the paper is that we should be we should be prepared to use fiscal policy more public expenditure, and that it should focus on investment. That's true. What happens when you start reading the borderline between rate of return on public investment and private rate of return, and you've still got an output gap that you want to deal with? You can hope that the government's going to sort out their energy policy, but if they don't, maybe the government does have to increase public investment.
But then the answer is that the government builds coal-fired power stations because the private sector won't. Is that really the answer that we want in the government to solve the problem that they've created in the first place?
Well,
I think not.
Well, I understand the
Quick
issue.
comment, and then we move on to next question.
Yeah, I'm Peter Chillip from the Reserve Bank of Australia. A question for Peter Abelson. You worry about over-reliance on monetary policy, and your particular concern seems to be the rapid growth in housing debt. Conventional economics would say that if you're worried about another social problem, that you use a policy instrument directly targeted at the source of the problem. And most central bankers would think that the appropriate way for dealing with rapid growth in debt is through prudential regulations, such as higher bank capital requirements. Is there some reason that you think tighter prudential regulations are unable to deal with debt?
I'm not an expert or anything remotely like it in prudential regulations, but I do have a gut feel that there are so many ways in which money can run around a system that prudential regulations on some entities in the system doesn't really deal with the problem if money is very cheap. There are ways in which people get hold of it through indirect means. So I'm not, as I said, I'm not an expert in that area, but my son recently borrowed an awful lot of money, and I'm sure that if we put a prudential regulation on a bank, he still would have managed it through some other system.
Economist penchant for generalisation from introspection. What I'll propose we do, there were three remaining questioners. Can we just take the three questions and then the panel can respond according to which bits of that they'd like to comment on, unless you specifically want to draw your question to the attention of an individual panel member. But starting here, there was a question over here, and then there. Yeah.
My question follows on from Peter's a moment ago. I'm Graham Wells. One of the, I think, unintended consequences of the division between APRA and the Reserve Bank is that some of the possibilities for using those sorts of instruments that Peter mentioned have been given up, at least in a counter-cyclical sense. So it's all very well now to be increasing required capital ratios, but things like counter-cyclical changes in loan-to-value ratios and so on are not really, from an outsider's point of view, easily available to monetary policy authorities these days. So I wondered whether anybody on the panel has any views on whether going back to some extent in giving the Reserve Bank control over those sorts of instruments might be a good idea.
Okay, keep that one for a comment. Next one over here.
Do you want me to just ask?
Yeah, why not? Yeah.
Yeah, this is more directed to Warwick. You mentioned before you like debt with an asset on the other side. I was just wondering if you could expand on what you mean, and also comment on what your feelings are if there's any issues with Japan's debt, for instance, and how that relates to your good debt asset, sort of where you sort of started to talk about it.
Thank you. And lucky last over here. And if you want to comment on anything else.
Okay. My question is to Warwick. There are two ways from the intergenerational perspective to reduce debt. One is through future taxation and the other way is through inflation. So do you think nominal GDP targeting or GNP targeting will bring in inflation and reduce the future debt?
Okay. start with Peter and move down to
Well, I think I've already revealed I don't know a lot about prudential regulations, and I'm a little bit sceptical. You know, money flows around the system in so many different ways that but I can't answer your question as to, you know, a change in the administration of prudential regulations. So Warwick would be better positioned to talk about that.
I'll do that at the
You
end.
want to come in on any of these?
Yeah, very briefly on this very same point. It is true we have a body, the Reserve Bank, which is in charge of monetary policy, and we have APRA in charge of prudential. But my understanding is they talk to each other an awful lot. And certainly we have the Reserve Bank governor talking about the problems of household debt. And at the time when he felt, or rather the interest rate was held constant, there has been recent changes in the prudential rules to manage that side of the if you like, asset issue. So I think it might appear to be that there's a divorce between the two arms of policy, but in reality, my understanding is that there's a lot of close collaboration.
Okay.
Yeah.
Warwick.
Okay, there's lots of good questions. I'll just come to this issue about debt and assets first. Yeah, my view is there is a role for government in building infrastructure, and as long as there's some independent agency assessing the rates of return, then it's perfectly fine for the government to issue the debt at a low cost to get a high rate of return, which has externalities for the private sector. So I think there's a lot of infrastructure capacity where we could borrow, we could issue bonds, 100-year bonds or 50-year bonds in Australia now, which would be snapped up in the global economy to undertake a fairly significant build-up of infrastructure programs, of projects that you can roll out as you need to, more quickly or more slowly, as a counter-cyclical policy. So I agree with that aspect. Japan, I mean, the gross debt to GDP ratio in Japan is 240%. That is really just a purely internal transfer from the young to from the future generations to the present generation. And that's the reason they sustain that is because somehow the society is willing to do that. For most countries, it's usually domestic foreign debt, which is a real problem because that is subject to the sort of crises that we see. So I don't think Japan will have a crisis. I just think that there's an unfairness in terms of the intergenerational issues. On Graham's point, I take the point that it's worth thinking about these issues, but some of the proposals that you see makes me think of going back to the 1960s in Australia, and that's the danger is if you are going to use there are very good, the loan devaluation counter-cyclical policy probably is a good idea, but there's a real problem of going back to the LGS, SDR, SRD type worlds because we got rid of that. We had inquiries and the allocation of capital improved dramatically after the financial system reforms of the 80s. So in principle, yes, it's worth people doing work on this, but in practice, I think the risk is that you're going to end up freezing up the financial system in terms of inefficient allocation of capital. And the third question over there, so when you look at situations in history where there's been large amounts of debt generated, the solution has always been inflation because you can't get the spending cuts, you can't get the tax increases, so ultimately you end up with an Argentina or a Germany in the Weimar Republic. You end up getting it inflating away. What I wanted to do with a nominal income target was to allow some of it to be inflated away because you can set a nominal GDP target of 8 or 9%, of growth rate of 8 or 9%, knowing full well that the underlying real growth rate's probably not greater than 3, and still have 5% inflation eating away while you do the other fiscal reforms, and that enables you to hopefully get to a more balanced fiscal situation. So I should have mentioned at the beginning, I can't remember if I did or not, that the nominal income targeting by itself doesn't change very much at all, and that comes to Peter Tulip's point. It doesn't really change. But if you have a fiscal framework where there is this split between capital and current, where there's a focus on getting the current expenditure not financed by debt, have the capital expenditure efficiently allocated, then there's a good case for the nominal income target to work in conjunction with that. So it seems to me that fiscal monetary change is something you do at the same time, if in fact you wanted to try and do that.
Okay, folks, our session finishes. We've got a bit of a tea break, and then there's a session continuing on in the same room on medium-term and long-term policies too, if you want to follow the logic. Thank you.